Jigar Mistry of Buoyant Capital is with us on the show now. Jigar, morning, and thanks so much for joining in. Wanted to share, with our viewers what you told us a little earlier today. That is that while the market is fundamentally well placed now, all the good news appears to be priced in. All the news, in fact, is taken by the markets as good news. And you find the markets eerily similar to where we were in 2018. Can you tell us your thesis and what does this lead us into in the future?
Right, Rima, good morning. Thank you for inviting me to your show again. Yes, promoter selling, so probably sort of increase in float, PE selling, so overhang gone away. Good news, obviously a thing to cheer, but bad news is also the worst is in the price. And therefore, all news apparently are now, great news, and therefore market seems to be responding to that. Now, what we were discussing was that if you look at stocks, right, these cycles are very well understood. Let's say if you identify a business that can compound earnings at, say, 20% CAGR for a very long period of time, then typically it's not that while earnings can consistently compound, stock prices rarely, if at all, do, right? The market, having found such a great business, starts dislocating, and you will have the first leg of the cycle when your stock price growth is much sharper than your earnings growth. So that creates the first leg. And then there is the second leg where the narrative shifts. Market is no longer interested in a business like this while the earnings catch up happen. And historically, if you look at Coca-Cola, that catch-up cycle lasted 20 years. IBM, it lasted 12, 13 years. Colgate in India lasted 15 years. So that at the stock level, it is very well understood and appreciated. However, at the market levels, there are these counteracting forces. So there are some businesses which are going a share price cycle, which is leg one. There are some businesses which are catching up on earnings cycle, which used to get counterbalanced. And in that scenario, your earning growth and share price growth, or index growth in this case, were sort of reasonably well correlated. I think now we have moved past that, where it appears that the market seems to be pricing in India as a great story. And there are legitimate reasons. Your labor force participation next 10 years is going to be phenomenal. We are, as I heard Nilesh Bhai say earlier, you are probably looking at a run of the capex cycle, which is unprecedented as well. So as a fundamental story, it's very well appreciated. As a sort of flow story, it is very well appreciated. But I think market in and of itself is going into this cyclical zone where it looks eerily similar to 2018. And if you look at the policy rates, you look at the GDP growth, it's all similar. Your current account deficits, gross fiscal deficits all look similar. But remember this, that in the 5 years, your earnings growth your index movement has been some 60-65%. And whereas it was 3 times that in 10 years. So the first 5 years, you have seen a large part of the growth. Last 5 years, not so much. And that's something which may recur once this sort of euphoria or the sort of sentiment settles down. And in which case, I think identifying which market caps to be in, which sectors to be in, which companies to be in will be even more important than what it's right now.
Okay, Jigar, got that. You were saying, what market caps to be in, what sectors to be in becomes important. I think you are moving away from the small caps and, preferring to look at the large caps now. Take us through your call there. And are there certain pockets of the small caps that you think are still okay and still have room to run up more? Or do you think it's just best to avoid the pack right now?
Good morning, Pavitra. So yes, we run a truly flexi cap scenario. We were almost 70% in large cap and cash by Jan 2022, just before the Russia-Ukraine conflict. And then sort of post that, we started adding a lot of small caps. So by March 23, we were almost 50% in small caps. And we are still sort of a little over 40% given the relative outperformance, right? So what was 50 in March actually expanded to a lot more in the intervening period. But increasingly, our investments are into a lot more sort of large caps, businesses which a lot of people may not like immediately. But if the euphoria were to boil over, then we will possibly want to protect the downside as well. Talking of those, I think, sort of banks in and of itself, we have been discussing, they present a different era post 2015, and that's something we continue to like. Increasingly, we are also getting into a lot of these consumption names. We are actively, so far we have avoided the big bang IT names as we have discussed in the previous years. But increasingly, they are also looking reasonably robust given the way things are. Consumption and capex also sort of is a place to be in. On the small cap side, I think within the IT pack, the ER&D businesses continue to look reasonably decent. We have discussed a lot of those names in the pack as well, and that continues. So they are not yet all that expensive. If you look at, say, 25 valuations, then they are in the mid 20 times most of these names, and that is an interesting place to be in.
Okay, got that, Jigar. By the way, I just want to point out that the flashes that you've been seeing run at the bottom of your screen, OCCRP, now this entity obviously has been making the headlines for the past 24 to 36 hours. It's a body that's funded by George Soros. It's a group of investigative journalists. That's how they describe themselves. And they have made certain statements on the Adani Group companies as well. This was yesterday. And also about Vedanta. What OCCRP is saying is flashing in front of you as well. And there's a response from Vedanta. Vedanta seems to be saying that a lot of the representations that are made from time to time to the government are in nature of ordinary business. That's sort of their response. We'll get Nisha in because she's been going through all the details of this story. The stock right now is up slightly higher. That's the 1 month. Yeah, today's is 1.5% higher. Anyway, it's a good day for metals. Overall, the metals index has been up and about. Jigar, so before we let you go, you spoke about consumption. On the commodity side, on metals or even oil and gas, I mean, do you have any interest here at all? There's the China angle. And then locally, of course, now we're getting into election season and we've seen what's happened with the LPG. What would your thoughts be over here?
Right. So I think, see, even with regard to how restrained sort of our MMDR policy has been. So I have been a metals analyst for a major part of my sort of sell-side analyst job, right? And we found this a lot more restrictive even then. So you used to visit China and you could set up a steel mill in 18 months flat. Right, and you are competing against those players. So it was always, at least as a sell-side analyst, my belief that the rules need to be a lot easier than what India was dealing at the time, right? The environment clearance used to take like forever, forest clearance. And then the new MMDR bill, which was proposed, sort of set to, regularize this in a lot better fashion. So easier restrictions sort of, see, for a country like at $3,000 per capita, 62% coming from services is abominable. So you need a higher production and manufacturing market share. And all rules sort of are welcome, which makes production an easier process for most industries. Now, within that, I think China has been in a negative newsprint for a while now. But a lot of these metal businesses do appear for a cyclical turnaround because eventually China is trying to stimulate. And the way in which that economy works, sort of if the government tries to do something, more often than not, it gets it done. So interesting place to be in, sort of steel more than non-ferrous, but interesting place to be in.
Okay, got that. So that gives us an idea for our next chat. We'll dive a little deeper now that we know that you spend so much time studying metal stocks. So I was looking forward to that one. Then you have a good weekend, Jigar, and we look forward to connecting again. Well, quick break right now, but when we come back, we are going to be turning on the economy full throttle. Of course, we got the GDP print yesterday, 7.8% is the growth in the first quarter. What lies ahead? And then we get a chat going with India ratings as well, because India ratings